Is this book still relevant today? This is a commonly asked question both on my channel and the Google search results, and one that I feel is worth addressing as its own video. What are some reasons that people might ask this question? The primary reason is that it was originally written in 1949. For the version that I have and that I'll be reviewing, it's the revised version. And the main differences between the original and the revised is that the revised version has commentary on how well parts of the book translate to today's standards, or explaining details and footnotes at the bottom of the page to make things more clear for all the readers. For my review of the book, I won't be looking at the commentary nor the footnotes to give a more harsh and better representation of how the original writing of Benjamin Graham translates to today. We mentioned that the book was originally written in 1949, so what are the biggest changes since then? Well, one of the biggest ones is that we have changed to fiat currency, and there's a big difference between the gold standard and the new fiat currency. Previously, if you wanted to exchange your dollars for gold, you could actually do that. But with fiat currency, your dollars are said to have value because the government says it does. Additionally, we are now globally connected due to the internet in ways that Benjamin Graham could not have dreamed about in 1949. Additionally, technology has advanced substantially and continues to gain pace, and thus controls a larger amount of power and usability as time goes on. There are plenty of other changes that have happened along the way, but these are some of the biggest that I think are most relevant to the changes from 1949 to today. Now, before talking about if it's relevant, we first have to talk very briefly about what's in it. I've made a video going into my review about The Intelligent Investor in more detail, but let's go over the topics here quickly. Here are the chapters that are found inside the book. There are 20 in total. Some of the names for the chapters were pretty long, so I shortened them so they fit nicely on the screen. There are general topics and specified topics spread throughout The Intelligent Investor. Some generic ones like inflation, advisors, and investment funds, versus some more specified ones like stock selection chapters and dividend policy. The chapters in green are the ones that I feel are 90 to 100% still relevant today. The reason I feel that they are 90 to 100% relevant is because they're based on general practices, history, human psychology, and decision making. And because people still act and think the same way they did since thousands of years ago, I feel that these chapters are still solid even now. The chapters highlighted in blue are the ones that I feel are 60 to 90% relevant. Most of the selections in this relevance range are in the defensive and enterprising investor choices for stock selection. The issue is that a lot of the guidelines laid out for what qualifies for a safe and reliable investment choice with stocks is not very feasible today. He gives incredibly conservative ratios and numbers that make finding a choice almost impossible. I've used screener tools such as FinViz to put in exactly the parameters that he's looking for, and I'll get often 0 results. The reason it's not lower in the relevance score is that he gives explanations on why he feels the number ranges are justified back in his day and what's the biggest issues to look out for when picking stocks. And although the exact numbers do not line up anymore in my opinion, his ideas on steady earnings and his opinions on debt loads and risk I feel are justified even today. So even though the exact numbers laid out in the book, although interesting to see what he felt in 1949 were good, I feel that the reasoning behind why he values the metrics that he does allows it to be in the 60 to 90% relevance score. And then lastly, we have the 0 to 60% range. Now this is where I disagree and think that large portions are likely not relevant today. Since there's only 2 and it is what I am disagreeing with the most, I'll go into these in more detail. And we'll start with Chapter 2's inflation. I got these charts from the US Bureau of Labor Statistics website, and the model for inflation and the change between all the dates, I chose the All Items Consumer Price Index. Now, the top chart shows the inflation levels that Benjamin Graham was used to and had experiences with while writing the book. As you can see, it has large dips and increases through the years of 1929 to 1942. And it's because of these big dips, it's why I feel that he often recommends having the even mix of bonds to stocks in their portfolio. Because when there were years of negative inflation, those bonds would truly shine with their stable payments and for their reliable yields. When there were very high levels of inflation, those stocks would really shine because now that bond that you previously had is much less efficient because now there's significantly more inflation and it can't appreciate with the price of inflation. versus the bottom one, which is what most of us are used to nowadays after being off the gold standard and onto fiat currency. The bottom chart is a much more condensed range and very rarely goes below zero, which only happened because of the 2008 financial crisis. And because it rarely goes below zero and is predictably around 3% each year, it makes bonds much less desirable, and additionally, bonds often offer lower yields than were available in 1929 to 1942. I will say that although this chapter is in the 0 to 60% relevance range, I feel like it's closer to 60 than it is to 0. And this is because his opinion on how to utilize inflation to your advantage I feel is accurate. Additionally, his opinions on how different levels of inflation affect bonds versus affect stocks is also still relevant today. The next choice is Chapter 19 on shareholders and management. This chapter talks about challenging management and their policy towards dividends. The first of which is challenging management. While I do agree that there should be competent people managing the company and that's obvious, I don't agree that shareholders should be actively persuading and forcing their hand into a majority of the decisions being made on the company level. He wants shareholders of all levels to be actively participating in the stocks they own and to call to question the competency of the managers of the company regularly. There are people who are considered activist investors who do this on a large scale. People disagree on things all the time. Just look at anything political. So raising issues with potential investments in new markets or anything that is potentially speculative that might go the way of the investors and shareholders versus might be a total flop will often feel like a lot of wasted time. The second is his opinion on the dividend policy. I don't think it's feasible to really be doing what he's talking about. A company, especially a growing one, is going to have a hard time paying out 66% of their earnings. Sometimes the company doesn't even have earnings yet. The redeeming part of this quote is that he says there should be a clear-cut demonstration, and that indicates that growing companies aren't held to the same dividend standard. However, trying to explain away that their retained earnings are more beneficial directly to shareholders than simply handing out 2/3 of their earnings seems hard to do. Imagine a new market for some new developed technology comes out. It's hard to say if those retained earnings are truly justified since it's a new venture with unknown possibilities. It's definitely true that if they are spitting out 2/3 of their earnings to shareholders, that their market share could suffer since not as much capital is being used to dominate the new market. Given the rapid developments in technology, there are more and more possibilities for things never imagined before. Plant-based meats, artificial intelligence, medicines, and so on. There are risks that companies have to push for the boundaries of their market to expand, and sometimes what they do won't work out. If every company decision had to be calculated and explainable winners for reinvestments or a heavy dividend payment, then not much advancement could really take place. So let's go back to our relevance chart. Listing out the amount of relevant, mostly relevant, and probably outdated or disagreeable chapters, we get 6 green chapters, 12 blue chapters, and 2 red chapters. Overall, the average for the book's relevance is somewhere around 80% relevant today. If you liked the video, consider hitting the like button and subscribing to my channel. Thanks so much for watching to the end of the video.